Welcome to this explainer. So, when most of us hear the phrase life insurance, we immediately think of a basic safety net, right? Something to just replace a paycheck if the unthinkable happens. But today, we're flipping that conventional wisdom entirely on its head. When you look at how ultra-wealthy families and highly successful business owners operate, life insurance completely transforms. It's no longer just a simple risk mitigation product. It actually becomes this highly sophisticated financial instrument acting as a structural anchor for some of the world's largest estates.
Which brings us to a really fascinating question. Why do many wealthy families continue paying large life insurance premiums even after they've accumulated significant wealth? Think about it for a second. If you've got tens or hundreds of millions in the bank, in real estate, or in a massive business, why on earth would you keep paying massive premiums? You already have the money. The financial security is literally already there. This is exactly the paradigm we need to shift today.
Well, for many families, life insurance isn't just about replacing income. It serves a much larger purpose. It's actually about protecting assets, supporting succession, and unlocking just unparalleled financial flexibility. And we're going to explore exactly how this works by breaking down the structural problems that huge estates face and how jumbo policies, where we're talking $5–10 million or more in coverage, are specifically engineered to solve them.
Section 1. Creating immediate estate liquidity.
So, a huge challenge for wealthy estates is the massive structural disparity between total net worth and actual immediate cash availability. Most of that high net worth wealth, it's locked up in illiquid assets. We're talking closely held family businesses, massive commercial real estate portfolios, and long-term private equity. Basically, they're asset-rich, but often cash-poor. And when a principal family member passes away, boom! The estate is instantly hit with massive cash requirements, estate taxes, outstanding debts, operational expenses. And here's the real kicker, estate taxes are usually due just 9 months after death. If the estate doesn't have the cash on hand to pay the taxman, executors are backed into a terrifying corner. They have to initiate rapid, distressed sales of prized family assets at a steep discount. But having the right policy can provide immediate liquidity if funds are needed quickly. It injects cash right when it's needed most, completely bypassing probate and helping avoid the forced sale of businesses, property, or investments.
Moving on to Section 2, balancing the family inheritance.
Okay, picture this scenario. Say a family's wealth is totally dominated by one illiquid asset. Like 60% is in the family business, 30% in real estate, and only 10% in liquid financial investments. Now, the parents naturally want to leave their wealth equally to their kids, but there's a huge catch. Only one child is actively running the family business, while the others have entirely different careers. If you just slice everything equally, suddenly inactive siblings own a majority of the business. Honestly, that is a recipe for operational disaster and some major family drama. And this is where life insurance can also support estate planning by helping balance inheritances between beneficiaries when certain assets, such as a family business, cannot easily be divided. We call this estate equalisation. Under this setup, the active child gets 100% of the voting stock, full operational control. Meanwhile, the inactive children, they inherit the life insurance proceeds, which are perfectly calibrated to equal the financial value of those business shares.
It is a total win-win. The active child doesn't have to share control or buy out their siblings, and the inactive kids get a prompt, tax-free cash settlement that isn't tied to the future success of a business they don't even work in. Most importantly, it preserves the working capital of the business. The company isn't forced to take on massive debt to buy out heirs, and you successfully dodge what could have been a generation-defining family feud.
Section 3. Securing business succession plans.
Look, if you co-own a business, the absolute last thing you want is for your deceased partner's shares to unexpectedly pass to an heir who has zero clue how to run the company, or worse, to an outside competitor. A buy-sell agreement prevents this. It dictates exactly how shares are valued and transferred. But a contract is just a piece of paper if you don't actually have the cash to buy the shares. That's exactly why business owners may also use insurance as part of succession planning or to help fund buy-sell arrangements between partners. It guarantees the cash is ready the exact moment it's needed.
Now, the mechanics of how you structure this are absolutely vital. You generally have two traditional paths. First is a cross-purchase agreement, where owners buy policies on each other. When one dies, the survivors get the cash tax-free, buy the shares, and this is a big deal. They get a step up in their tax basis, which reduces future capital gains taxes. But what if you have 5 owners? Suddenly you're managing 20 different insurance policies. It's an administrative nightmare. The alternative is an entity purchase, where the business itself buys the policies. Super simple, just one policy per owner. But the surviving owners do not get that basis step up, and the cash value could potentially be exposed to the business's creditors.
So how do the really sophisticated planners get the best of both worlds? Enter the insurance-only LLC. They create a separate limited liability company strictly to hold the life insurance policies. Upon an owner's death, this LLC collects the proceeds and distributes them to the surviving members, who then execute a personal cross-purchase of the deceased equity. It's incredibly clever. You keep the administrative simplicity, you protect the policies from operating business creditors, and you secure that highly coveted tax basis step-up. Brilliant legal engineering right there.
Section 4. Trust structures and tax treatments.
For these policies to really function efficiently as estate planning tools, they're almost never owned by the individual directly. Usually you place the policy inside a private family trust or an irrevocable life insurance trust, commonly known as an ILID. Setting this up means defining clear objectives, drafting a meticulous trust deed with a specialist lawyer, and properly transferring the assets. When you do it right, the trust completely ring-fences the assets. The death benefit is removed from the insured's taxable estate, totally safe from future litigation or insolvency proceedings.
Now keep in mind, the exact benefits and tax treatment depend entirely on the policy and the laws that apply in your specific jurisdiction. Take India's Income Tax Act, for instance. What does the number 10 mean here? Well, under Section 1010D, maturity proceeds from a life policy are generally tax-exempt, but only if the premium paid in any given year stays below 10% of the sum assured. So the rules can be pretty strict. But universally, across many regions, death benefits paid out to nominees remain fully exempt from income tax, regardless of the premium amount.
But this raises a very practical question. How do the ultra-wealthy actually pay for these massive policies? Do they liquidate their high-performing stock portfolios or sell prime real estate? Honestly, rarely. Instead, they use premium financing. They literally borrow the capital from a lender to pay the insurance premiums, using the policy's cash value as collateral. This lets them secure tens of millions in coverage while keeping their core assets fully invested, completely avoiding the massive capital gains taxes a sale would trigger. It is leverage, used masterfully.
Section 5. A larger wealth strategy.
So, pulling this all together, for many families, insurance is not the entire plan. It's one important piece of a larger wealth strategy. It works hand in hand in a complex ecosystem with legal trusts, business succession plans, and investment portfolios. It creates that vital estate liquidity to pay taxes without fire sales. It equalizes inheritances to keep family businesses completely intact. It guarantees succession agreements are actually funded, and it wraps all of this in highly tax-advantaged trust structures.
Because at the end of the day, when implemented correctly, this is what strategic life insurance actually does. Protect wealth, preserve choices. By having liquidity exactly when it's needed, you aren't forced into terrible decisions by external pressures, like sudden tax deadlines or creditors. You preserve the choice to keep the family business, the choice to hold on to legacy real estate, and the choice to pass your wealth on equitably and peacefully.
Which leaves us with a final thought for you to chew on as we wrap up this explainer. Look at your own long-term wealth strategy. Are you actively structuring your wealth to create choices for the next generation, or are you kind of just leaving it to chance? Proper planning takes real time, coordination with experts, and foresight. So don't wait until those options disappear. Thanks so much for joining me for this explainer. Keep learning, keep planning, and I'll catch you next time.